Today, we will talk about the cup and handle price pattern. A cup and handle price pattern on a securities price chart is a technical indicator that resembles a cup with a handle, where the cup is in the shape of a U and the handle has a slight downward drift. The cup and handle is considered a bullish signal, with the right-hand side of the pattern typically experiencing lower trading volume. The pattern's formation may be as short as 7 weeks or as long as 65 weeks. The cup and handle is a bullish continuation pattern and is used to identify buying opportunities. A retest of previous resistance is not required to touch or come within several ticks of the old high. However, the further the top of the handle is away from the highs, the more significant the breakout needs to be. There are several ways to approach trading the cup and handle, but the most basic is to look for entering a long position. Place a stop buy order slightly above the upper trend line of the handle. Alternatively, wait for the price to close above the upper trend line of the handle, subsequently place a limit order slightly below the pattern's breakout level, attempting to get an execution if the price retraces. A profit target is determined by measuring the distance between the bottom of the cup and the pattern's breakout level and extending that distance upward from the breakout. Stop-loss orders may be placed either below the handle or below the cup depending on the trader's risk tolerance and market volatility. Now let's consider a real-world historical example using Wynn Resorts, Limited, which went public on the Nasdaq exchange near $13 in October 2002 and rose to $154 5 years later. The subsequent decline ended within 2 points of the initial public offering price, far exceeding O'Neill's requirement for a shallow cup high in the prior trend. The handle follows the classic pullback expectation, finding support at the 50% retracement in a rounded shape, and returns to the high for a second time 14 months later. The stock broke out in October 2013 and added 90 points in the following 5 months. Like all technical indicators, the cup and handle should be used in concert with other signals and indicators before making a trading decision. Certain limitations have been identified by practitioners, including the time it takes for the pattern to fully form and the ambiguity that can exist in some cases. Another issue has to do with the depth of the cup part of the formation, and the tendency for the pattern to be unreliable in illiquid stocks. Here are 4 key takeaways. 1. A cup and handle is a technical chart pattern that resembles a cup and handle where the cup is in the shape of a U and the handle has a slight downward drift. 2. A cup and handle is considered a bullish signal extending an uptrend, and it is used to spot opportunities to go long. 3. Technical traders using this indicator should place a stop buy order slightly above the upper trend line of the handle part of the pattern. 4. The pattern was first described by William J. O'Neill in his 1988 classic book on technical analysis, How to Make Money in Stocks. Hope this would help. Thanks for watching.